All right. So, so thank you everybody for joining today. I'm Eric Bramlett. I'm the broker owner of Bramlett Residential,
I'm Max Lehman, CEO of Loan People.
and today we're gonna do the inaugural "What's Your Angle" podcast. Kind of a working title that maybe sticks, maybe not. How are you doing, Max? What'd you get up to this week?
I'm good, man. I was in Nashville on really Friday to Wednesday at a mortgage conference, so that was fun. Always a good time. Learned a lot. We were operators, just getting kind of more of a sense of what's going on with everybody else. Signed a bunch of NDAs, and everybody really just kind of opens the doors to inside what they're doing. So it was great. We learned we're doing mostly everything as good as you can. And
so the vibe was solid, right? Like big party, like everybody's printing money and
oh yeah, it's like it's 1999. It was a little more solemn. Everybody kind of walking around a little bit with their head down a little bit more, and that kind of thing. But it's it's good to be around your peers, and people always want to kind of compare yourself to others, right, to a certain degree. So the misery loves company feeling, like it's knowing that it's not just you, and then seeing that unfortunately some are not doing as good as you. There's a certain okay, it could be worse kind of feeling that goes with that.
Yeah, definitely. I know I call you all the time. Anytime we have a dip in leads for more than like a week.
An hour.
I call them like, what do locks look like, Max? Are they
Right.
also down? And I don't want the locks to be down, but it always is comforting to know that we're not doing anything wrong.
I love it when your pendings are equal to my apps or locks. Like that's always.
Yeah. Well, great, man. I'm glad you're back. I'm glad you're back in town and had a good time there. I'm sure there was some exciting stuff.
Yeah.
So, in the interest of kind of having a structure here, what we want to talk about in the beginning of every podcast are the qualifications of any guests we have. And we obviously don't have a guest today. We actually have a couple of guests lined up that we're really excited about that we'll talk about, in the future. But why we want to talk about qualifications is that it's important to know who you're listening to, right? Like, what have they done? What's their experience level? So, Max, if you can give us a quick rundown of your history in the business, where you are now, why you're qualified.
Yeah. So I got in the business July 9th, 2001 was my first day. For me, it just always kind of clicked. I was really, really quick to start kind of putting the pieces of the puzzle together when it comes to structuring a loan, figuring out how to navigate guidelines, that kind of thing. I very quickly became kind of the go-to for veterans at the time to come and like, how would you do this? How would you put this together? What do you see here? I was always kind of a leader, probably. Before I got into the mortgage business, I managed a cell phone shop, and in high school I managed 5 bagel shops, and I was just always kind of had this leader mentality.
Right.
So sometime around 2004 or 5, I became a sales manager, and then branch manager, and then quickly started from there, kind of building out Lehman team, which started in about 2009. Really from like 2010, 2011 on, we were really able to build something pretty special, pretty quick. I've always had multiple loan officers on my team, but when we look at numbers, Max Lehman, the loan officer, we got ourselves to number 1 in Austin in 2010 or 11, and really have stayed there ever since.
So I remember you and I started working together in 2009, and when we started working together, you showed up to every closing, and then that stopped pretty quickly because you guys were doing so well that you couldn't keep up with it.
Yeah. You still try to go every now and then, and it gets to the point where there's not enough time in the day. And it's interesting. Like, sometimes it can be good to be at a closing, but a lot of the feedback that we would get is like, hey, if you're here at closing, then what are you doing? How are you helping my clients right now? And so
Right.
There's two schools of thoughts there. But yeah, we the point where Lehman team was the 4th largest company in Austin when you really broke it down, and through a circumstance of events, decided we were going to do our own thing. So we spent all of 2019 opening up and preparing Loan People.
Right. That was a big deal. I remember you guys were you were kind of doing it behind the scenes for a bit because you obviously had to operate and you couldn't let the last bank know that you were putting that together. So
Yeah.
I remember you being super stressed with like 2 different computers working from.
Yeah, that was running commercial space.
Yeah.
You know, there was a time, but you know, it worked out, and we opened our doors January of 2020. I sat with so you know, we opened, and Lehman Team is the only group at Loan People.
Yeah.
All of a sudden, COVID, you know, hits, and so we're open January. March, COVID hits, and I brought all the loan officers in, and I was like, guys, I don't know what's going to happen.
How many employees did you start with whenever you started in 2020?
24, 28, somewhere around there.
A lot of overhead.
Not too bad. I mean, you know, it was office and salaries and stuff, you know, enough to, it was fine. It was expected. You know, now we're 116, and we've been able to grow, you know, obviously 20 and 21 and 22, even though not as good as 21, were phenomenal years. But we've also in 21 started growing out the company and adding other loan officers and other branches. And now we're in San Antonio, we're in New Braunfels, we're in Houston, Corpus, got a gal in Oklahoma as well.
Nice.
Lends on a bunch of cities in Central Texas that you never heard of, Tig, Mejia, that kind of place. So, you know, it's going great, and you know, it's not without its trials and tribulations, especially in this market. But I'm super happy that we've done this.
Yeah, absolutely. I mean, and I think the headline is that you're running a bank now. It's not Max out of his office. It's Loan People, which is really impressive. And you know, scaling to different levels is it's difficult. You know,
it is. You know, I think one thing that gives us an advantage really over our competitors is that I am the owner, the CEO, but I'm still also originating some. So I've really got my finger on the pulse as to what loan officers are going through and what real estate agents are going through. And like, I've really got my pulse on the street from both sides of it. So what about you, man? Like, I know you, I know your story, but tell us.
I'll try to give the quick story. I got into real estate in 2003. I didn't really know I didn't know what I wanted to do. I moved to Austin. The story was that I was going to move to Austin, go to law school. I was waitlisted at UT, and then was having a lot of fun working at a bar downtown. So I was pretty happy I got waitlisted that I didn't have to go. And then I got pretty sick of you know, working in a bar downtown pretty quickly, and didn't really know what I wanted to do. Got licensed just because I didn't want to work in an office. I heard that you could make money, you know, selling real estate. And it was like relatively easy for a while because we were coming out of a recession at that time, and I had no idea. So I got in, and it wasn't like immediate success or anything like that, but I did figure out how to generate leads through internet marketing pretty quickly. And I was so young that nobody took me seriously to help them buy and sell. So I was doing a lot of apartment looking, but I kept that internet marketing, you know, knowledge with me. And as I progressed in the career, I learned how to generate like buyer seller leads, and things were pretty easy. Then I remember everybody says 08 hit, but it was really the second half of 2007.
Yeah.
Sort of like everybody's going to call it 2023, but it was really the second half of 2022.
Right.
And yeah, it went from, you know, like leads coming from the sky to all of a sudden like still leads, but you couldn't qualify any of them.
Yeah.
So, you know, I was like, all right, well, that was a good run. Now it's time to get serious. Now I'm going to go to law school. and I applied and got accepted that time. And then I got a letter from the IRS, and they audited me. And I realized that I was going to probably have to like sell my house and do all this stuff. Yeah. So I did the math, and I said, okay, if I do this, if I go to law school, I'm starting over. I'm probably not going to be successful as early as I'd like to be. So I got really serious about real estate then. You know, there were some things that happened. I had a business partner who's an amazing guy. We ended up parting ways in 2012. I was laser focused on my own production. I wanted nothing to do with management. You know, it's real estate's really lucrative, and the harder I work, the more money we get. So that's what we're going to focus on. We had excess leads. So, you know, we had one agent, then 2 years later, we had 2 agents. And then, you know, 3 years later, I think we had 4 agents. It grew really slowly at first. And then in 2020, we decided, hey, we have a really strong infrastructure here, and we think that we can grow more and not lose quality. That's always been my number one thing, is that I don't want to dilute the quality of the people that we get to work with. It's kind of a selfish deal. And yeah, and we did. And right now, not by agent count by any means, because we're not looking to grow volume, meaning the agents that are coming over and the volume they bring with us. We're the fastest growing independent brokerage in Austin. We're almost the fastest growing brokerage in Austin, but who we're competing with are like, these really big brokerages. So that's not something we're going to chase forever. We certainly want to maintain quality. It's the number one thing. And,
well, I think that's important too, right?
Yeah.
Like quality over quantity, 100%.
Right.
We've always kind of had that same mentality here.
Right.
We're not necessarily a shop for everybody, but good quality technicians, people that know how to put loans together, that aren't just throwing a bunch of stuff against the wall to see what sticks and come up with the system.
Right. Yeah. Well, congrats on your success. I always joke that, Max and I are really good friends and we share a lot of like hard numbers, and he's a really humble guy, and I feel like we're kind of successful, but you can usually 3x whatever it is we're doing, and that's where Max is on it. So congrats on your success, man.
Yeah, you too, man. Thanks. I wish it was 3x this year.
It's 3x loss this year.
Exactly.
So anyway, in keeping with like introducing the podcast, we want to talk about, well, and before we get to this, we'll talk about what the topic's going to be today. So we're going to talk about a market update, which there's not a whole lot of news other than things keep saying, but we'll talk about that. And then we're going to talk to you guys about leading indicators and why we care so much about those. So we are going to get some good, content. Not that this isn't good content. We want to keep introducing the pod. So why do we want to do this? Like, Max, why did you decide that you wanted to do this? When I pitched this to you and said, hey, I think we can do this on a monthly basis, what do you hope to get from it? Why do you want to do it?
So, the old, you surround yourself with successful people,
right,
to be successful, right? There's so much that I don't know. I try to learn every day. We have some really successful friends, and there's people in other cities and states that I know that you don't, and vice versa. And to have a forum, a medium where we can really sit down and, I mean, you talk and you kind of shoot the shit and that kind of thing, right? But like to really sit down and like have a conversation with somebody who's done something and is successful in their line of work, and that does not real estate or mortgage. I mean, it's just, so how did you scale? How did you grow? How did you advertise? Whatever it is. So I'm really, really curious to dive in with other people and really kind of take a deep dive into seeing what they've done, how they've gotten to where they are, and what years they've had.
Absolutely. And that was something that when we were talking about this, Max, I don't know who finished each other's sentence, but we said, we want to have people from outside the industry, and the commonality is success and kind of a unique look at how did they find their success? What's their angle, right? And I've found that successful people in really any industry, a friend of mine founded a rewards program, right, that did really well, and they exited. And when I talk with him about business, it's common themes that like Max deals with and that I deal with and that agents deal with. So I'm really excited to bring these folks in. I feel like I've learned a whole lot from people outside the industry my whole career, and within, obviously.
Sure.
But hopefully some unique perspective.
Yeah, that's I think I'm excited about it, and I'm super interested to see where this thing goes.
Yeah. You said conversations with the guests, and that's obviously a big goal of mine. I want to start conversations with everybody, right? I've learned so much through collaborating with people in real estate, outside of real estate. What I found is like the more conversations that I have with really anyone who is smart and not even just successful. An agent from outside of Austin that hit me up randomly, just wanted to talk about pay-per-click marketing. And okay, great. And we started chatting about it. It turned out like he was way further along on a specific campaign type than I am. And so I ended up learning quite a bit from him. Hopefully I gave a little bit to that conversation. But the more that you talk with smart people, the more that you talk with people who are like-minded in how you do business, good things just happen. And that's one of my goals is to hopefully meet some folks. And if we end up getting referrals in and referrals out of the deal, like that's great too.
Yeah.
So, yeah, obviously. So we kind of hit on everything that we hope the podcast to be. And I guess, do you want to jump in to where are we in the market right now and where you feel? Do you want to talk about the mortgage market for a bit, and then I'll talk about kind of where I feel like the real estate market is?
Yeah. So the mortgage market, as I alluded to earlier, is super slow.
Refi business is booming this year, right?
Oh, and
everybody wants to
absolutely.
refi from 3% to 7%.
I talked to a lady today that needs some help with something, but it doing what she wants to do means she gives up to 2.5%, 2.75% rate. So,
right.
But it's definitely a difficult time in the mortgage industry right now. There's no way to sugarcoat that. Mortgage apps are at 1995, 1996 levels we haven't seen in a while. I actually ran a stat. I don't think I've told you this yet. I ran a stat yesterday. Lehman Team's always kind of been my basis for everything because that's been the one constant. So when we look at just total leads that have come in 2021, it was about 5,500 leads that Lehman Team got.
Okay.
In 22, it was about 3,300. And
yeah, that's the refi difference, right?
Oh, for sure.
Yeah.
I mean, and purchases, and it's probably more in 21 because there was a lot of refis that didn't even get logged because it got to the point where we were turning away business.
You guys were telling people that you could close a refi in 60 days, I think, in order to accommodate the purchase.
Well, we were doing some 90 days, and then we shut off. If you weren't an existing customer of ours, we shut off the refis and just said, "Sorry, we can't help you." There wasn't enough capacity, and purchase business is always number one. And even through that time, we're normally about an 85% purchase business team.
By the way, I've always admired that you've done that, and I didn't understand that. Like it is like kind of self-interested that you do that because it's much more constant, right? Yeah, but those you build relationships with people who continue to send you purchase business. You don't generally get as many relationships for the refis, right? Like you have to do a lot of outbound for that.
Well, yes, but the bigger issue is I've seen several refi busts now.
Right.
In one, and if all these shops that are primarily refi, they go out of business.
Right.
It happens overnight.
And to explain that dynamic to like agents who are listening. So if you think about it, it's very logical. If there's a refi boom, it will be followed by a bust every time. It's impossible for there to be a prolonged refi boom because everyone smart who refis is refied, and now they're just not going to refi it.
Well, and now I believe the stats something like 80% of the people out there have a rate under 6%.
Right.
And something like maybe I won't even say it. I'll be making it up, but there's a substantial amount of people that are still under 5. And so when things turn around, 24, I think you'll start to see some relief of rates. Really, second quarter of 24. I think the Fed's probably gonna have to start pivoting and cutting rates in 24. They're markets a chance that they stay where they are and they meet next week. November, December, January is still a little. It's still unknown, and you really got to go off.
I think you guys will. I mean, to be honest, like I don't want to predict this far in the future, but I will. I think you guys will see a refi boom in 26, and the reason for that is I think we're going to see. I think you'll see a lot more refis in 25.
Yeah.
From people who bought. There are people buying in 23 and 24. They're all going to refi in 25, and then I think you're going to see a lot of people who bought in 24 and 25. Like there should be a lot of volume then. And the rates should be lower in 26, and you should be able to turn a lot of those loans because people don't. You're correct that some people stay in their houses like now because they have a low rate, but it doesn't matter how low your rate is if your house is too small for you.
Life events happen, but the other thing too, don't get it twisted for any loan officers listening out there. When rates come down, this isn't going to be like anything like we've seen in the past. There's just not that many loans to refi. So there's going to be an opportunity for everyone that's taken out a loan basically since May, June, July of last year to get down. But the other thing, what happened in 01, 02 during that time frame, rates came down really slowly. So when I got into business, 2000. When I got into business, if I could get you 7%, it was the equivalent of you getting 3% during COVID.
Right.
You loved me. Now, obviously, people have gotten more accustomed to where that is. But during that time frame, rates, they didn't spike down. They came down slowly. So there was a lot of people that would refi, and then they refined again in a year and refied again in a year.
Well, that's when they're doing a lot of cash outs, right?
There was some of that, but it's also, rates drop half a point or a point, it can make sense to refi.
Right.
So, I think it's going to kind of be more like this,
Similar.
So yeah, it's we'll see what happens. Rates, the average rate today, via Mortgage News Daily was 7.29.
It's been in that range for at least a month and a half now, right?
Yeah, it's been up there. We peaked August 22nd. It peaked at 7.49.
Yeah. That was scary. It looked like, I mean, not scary because it's not going to do a whole lot, but it looked like it was headed towards 8, I thought.
Oh yeah. Well, and today we'll see what happens. The 10-year is up at higher levels today. It's sitting about 4.336 today, which is kind of where we hit back 3 or 4 weeks ago, and we're kind of at this particular level. So if we can keep from going over about the 4.34, 4.35, that's really ideal, because if we start closing over there, then there's precedence to believe, just from a technical chart. And by the way, I'm not a technical analysis. I only listen to people that are smart.
For sure. Well, that's really, it's either really efficient or really lazy. Like one
Probably
of the two.
both.
It's probably both, right?
But
when I put solar on my house, I didn't research any of it because one of my good friends who I ride with researched the hell out of it, and I was like, great.
Well, I know this about you too. Like you're always like, well, so and so said this is a good idea, so I'm going to do
it. It doesn't. It works. Like if I know that person's reliable, why would I bother with looking into it?
Of course, of course. So yeah, what we don't want, if the 10-year starts bouncing up over that and getting to 4.5 or whatever, 4.75, then it's likely we could see rates at 8.
On that same note of I just listen to people who are smarter than me. I'll share the screen with everybody, but this one of my friends, Jay, who I think told me about this. It is the CME FedWatch tool, and it shows you real time what the percent prediction is.
That's awesome.
Yeah, so they're saying 99% chance that the Fed will not raise rates. I think it's in 4 days, which makes a lot of sense. I mean,
what does it say for November?
I don't know. Where does it? I don't know. Oh, November. There we go. I didn't even see that. 73% no, 26% yes.
Yeah.
So, I mean, obviously, I think
push that out to June. What does it show in June of 24?
I mean, it's going to get less reliable the further we get.
Yeah.
So target rate, that's down, right?
That's down. Yeah. So that they start looking at 40%
when they're going to lower. Yeah. And then as we dig into leading indicators, which we're going to talk about, this is sort of the ultimate leading indicator. And I will say this, like if you're trying to strategize around stuff, like you can't really like bank on this. This is 100% going to happen, but you can say this is the highest likelihood that this is what's going to happen, and you can sort of plan your business. You can plan your business around.
But you also have to be able to pivot and understand you need to have backup plans, and you need to be able to pivot quickly.
Yeah.
Because especially in this business, like we saw last.
That's why I'm applying to law school next year. Just
it's probably smart.
Yeah.
But as fast as we saw rates spike last year, it is also possible that this thing could reverse super quickly as well. So you always, in business, you've got to have contingency plans. But
I will say this, like, what do you see the likelihood that it reverses? Because in order for the Fed to reverse, the inflation would have to spike.
Well,
because inflation, if you think about it, like the CPI is kind of the leading indicator on
it is
on what the Fed's going to do.
Well, it's really core is really what
core,
core they strip out. And it was really interesting because earlier this week, CPI came out. Numbers were a little bit hotter than it's been.
But the core wasn't. The core dropped, right?
Yeah. Was it?
I've got it in our notes.
Yeah.
Section.
No. It core went up.
So the last report from earlier this week.
Mm-hmm. Yeah. It went from.
No.
Sorry. It was
the other way around.
It was the other way around.
Yeah.
But what's good about that energy was that was kind of the big one that was dragging up CPI.
Right.
But shelter costs are really showing signs of coming down.
Okay.
And that's really what the Fed wants.
Housing costs. Yeah.
Yeah. So as long as that keeps happening. So anyway, all that happened, and typically on a day where CPI comes in higher, you're going to see mortgage rates get worse. But because when you really start, and they immediately did.
Right.
And then you start stripping down and looking into what's happening, and investors said, oh, okay, well, shelter's coming down, and so that was a good day, but then we certainly made up for it and had a couple of bad days since. So.
Yeah. Well, it's interesting. I mean, watching what they do, they're relatively predictable, and because they typically they tell you what they're going to do, and then they don't change course very often. So it's a big deal when they do change course. We'll talk about like the actual definition of leading indicators and lagging indicators in a minute, but sort of the leading indicator to the real estate market will be mortgage rates, which are we always tell everybody like, oh, if the Fed goes up, it doesn't mean rates are going up. And that's true. It's not directly correlated, but it's so
generally, but where
It's-
it is now, it's like, if the Fed raises rates,
The
mortgage rates,
mortgage-
100%.
Yeah.
But also it's important to understand too, as the Fed starts lowering rates, mortgage rates will react positively.
Yeah.
But in a normal market environment, it's not about what the Fed does. It's about what the Fed says they're going to do next.
Because
And what the
everybody's
market-
anticipating.
That's right.
Yeah.
That's right.
Yeah. So to dig into what's going on with the real estate market, we're just sort of in a standby mode right now.
Yeah.
We're going to continue. We will continue to see year-over-year declines, more than likely until next year, and that's only because the market was hot and it was a gradual cooling off period, and we won't see things improve. Well, sorry, the two components are jobs and mortgage rate, both of which are heavily influenced. Influence is the right word. Both of which are heavily affected by the Fed. So if you want to know what will happen with the real estate market, which would know, look at what's happening with jobs. I believe you have to dig deeper than unemployment and look at what's going on with mortgage rates, and then you go one level up, and that's what is the Fed doing? And right now we're kind of waiting on the Fed to announce that they're done raising. Correct?
Yeah, but I don't think that they'll announce it.
You don't think so?
I don't think that they'll say we're done, we're here. I think they'll just stop.
Just so.
And you'll probably have a couple of months where they've stopped. I'm still of the belief that they're going to break something and they're going to have to turn around and they'll just start cutting. So I don't think they'll ever say they're going to stop. I just think something's going to break and they're going to have to.
Well, let's talk about that, because that's new information. It's not new information that you and I haven't talked about, because we talk about it all the time, but whenever we've done these in the past, we haven't gone sort of that deeply into that conversation that you and I have a lot. And the fundamental, it's not even a disagreement. I think it's more like an optimism, pessimism thing. And I don't know when I turned into an optimist, but the Fed is looking for this soft landing. And I think it's relatively strong likelihood that they're going to get it. And Max doesn't think that. Max thinks that they're going to break something.
Well, I do think they're going to break something, but it also is starting to appear to be more likely that that's going to happen. But look, let me kind of back up here, right? Let's see what happens in the rest of this month and October with the stock market specifically, because if the stock market takes a 20% turn for the worse, that's.
I haven't even paid attention to the stock market. What's going on with it?
Well, I mean, it's been we've had a couple of bad days here, and it's like, you've got the tech sector and things are really, they're turning a little bit. Like, we're coming off the highs.
But describe, so to sort of like explain it to everyone out there though, when you and I say break something, we instantly know what we're talking about because we've had the discussion 100 times. Describe break something, like, and maybe with an example, like,
well, I think, like I said, I mean, as the Fed, we saw the stock market, especially like when you look at Apple, Facebook, Google, Tesla, all of those, back in May, June, they really peaked. Like, if you look at Apple, for example, I'll just pull this up. Apple actually got to an all-time high. It was in August. It got to 197, and now we're sitting at what is this? About 175. I think some of this is.
But that's not breaking anything. I mean, that's a dip. Yeah.
No, but it's because the market was looking at the Fed's not going to, or the Fed's going to start cutting rates, and now it's looking more likely like the Fed's not going to cut rates.
Okay.
Right. So the market's always pricing in what they think is going to happen.
Right.
If the Fed's not going to cut rates, you very well could see the stock market take a 20% tumble.
Yeah.
That, in my opinion, could be the thing that gets the Fed to say, okay, this is enough. I don't think that the Fed really wanted to, well, they wanted a housing recession, which they got.
They got it.
They really want a jobs recession. And it's not quite happened. But when you look at the jobs numbers as well, like, are they really what they say they are? I question some of that.
I question the unemployment rate.
That's what I'm saying.
Yeah, I think that, we've talked about, people entering the job market again? Are people dropping out of the job market? And it's
Well, and also like when you look at that, right? Like a lot of people 55 and older going back to work.
exactly.
You know, so there's a lot of that stuff that's not.
But to go back to what we were talking about, like with does the Fed break it? So I don't know that I would. You and I can like thumb wrestle over whether or not a 20% dip in the stock market is breaking anything. It's certainly not good, but I look at breaking something as if the Fed tightens so much that it starts collapsing, corporations.
Well, look what they already look what happened with Silicon Valley Bank.
For sure, but that's not breaking it. That's not breaking an industry though.
No, but that's because they had to backstop it, and there very well could be more bank failures.
I think that's the most likely thing that they could break is these regional banks. And if that happens, I don't know that it changes the timeline, but this is where I think there's a likelihood that they get a soft landing, that there might be some more bank failures, but not like an industry-wide, like not a 2008 where we had this fundamental problem of bad loans in the system that had to wash out. That was totally
that won't happen. Everybody's qualified now.
Well, in the commercial space, maybe not, but that's a different conversation. But what happened, like to summarize a conversation we've had in the past, it's that the Fed can break things by increasing interest rates so much and reducing liquidity. The banks can't loan, and industries who need that money can't get it.
Right.
And then you start seeing failures, and when you start seeing failures like at a systematic level, like there are multipliers of this happening. That's when I look at it and say, okay, the Fed broke something.
Yeah.
But let me ask you this, like, if that happens, then what does the Fed do?
Well, they got to start cutting rates.
Exactly, and printing money, right?
That's right.
Exactly.
Right.
So let me ask you this: if we both agree that the highest likelihood is the Fed starts lowering rates let's just call it next June,
Sure.
Right? And there's a likelihood that they could break something between now and June. What's the likelihood that rates are down next June in one way or another?
I very much believe rates will be down next June. Down to what? I don't know.
Right.
Again, we're at whatever 7.29 today. I think it's highly likely that they're at least in the sixes by next June. NBA predicts that they're going to be about 6.5 by the end of the year. And everybody has predictions, and I've seen numbers range between 6.25 and basically 7% is where people think rates will be by the end of the year.
By the end of this year?
By the end of this year, yeah.
Yeah.
I mean, we'll see what happens. It very well could be.
It takes some real speculation to get them down that far. Not by us. I mean, I'm saying there would have to be strong belief in the market.
By the way, I don't think rates will be 6.25.
Yeah.
By the end of the year, I think it's possible they could be under 7. I mean, that's only a quarter from where we are now.
Yeah.
And I mean, look, the fact is, you can still get a rate today under 7. So like when we talk about rates, I talk about the average rate,
Right.
Not like there's still, you can lock in, you can pay, if you pay a point today, I mean, you're going to be in the high 6s. So there's some of that as well. So people need to definitely understand that just because we're talking about an average rate of this, like,
but we can summarize it by saying rates are high. That's so I'll say this, and to kind of like circle back to what's going to happen in the real estate market. Well, seasonally, the market's going to suck. It just kind of always does in the late fall, winter months. And I am not glad that rates are high, but if there is a time of year that I would prefer rates to be high, it would be this time of year.
Sure.
I don't think we're going to see any improvement whatsoever over the winter months in terms of like what a normal winter looks like, which is it's a literal and figurative winter of real estate. Yeah. I think the first opportunity that we're going to see any improvement will be in late Q1 next year in terms of the real estate market. And that I think if I'm right, and this is where like what you're projecting, what I'm projecting differs slightly, because I think what we're both projecting is that there will be market improvement in the market in Q2 of next year, like late Q2.
Yeah.
Do you think that? I mean,
yeah.
So it's kind of how we get there. And if the Fed breaks something and there's a lot of turbulence, like in the news, the sky's falling for a short period before the Fed swoops in and lowers rates,
right,
then Q1 next year is not going to be any good. And early Q2 is not going to be any good until they start improving things.
Right.
If the Fed has a soft landing, then people will start getting more and more optimistic as it gets closer to the Fed lowering rates. And that's where we could have a pretty okay spring next year. So I think those are the two scenarios that we're kind of looking at.
Yeah, no, I don't, as far as having an okay spring, okay summer, I think one of those are likely.
I think, yeah, definitely. Okay. Gosh, that's what we're shooting for. It's better than now.
Let's hope it doesn't suck. As long as it doesn't suck.
Well, I'll tell you this. I mean, we've muscled through this, almost 3/4 of a year, and it's not killed either one of us. So.
No, and this has really been going on for a year, really for more than a year. This really started about the middle of May last year is when we kind of saw this starting, and then last August, it really got bad, and then September rates jumped. I mean, I was at this conference this time last year, and rates worsened by 150 basis points in one day.
Right.
It was like the worst day in the history of mortgage-backed securities, maybe ever. It was awful. So it's
well, and I'm a broken record here, but what do you do, right? I mean, I know what you say, what you do. Like,
yeah, you put your head down, you work harder, you control what you can control. You can control your activities, you can control your productivity, you can control your mindset. Mindset is huge. You can just keep going.
You can't,
or you can put your hand in the sand and watch everything fall apart. But
right,
I think that's what really, like, the good thing about this is the best of us will be fine. And it will clear out the ones that got in, at least from the loan officer perspective, and probably the real estate.
Probably
the real estate perspective too. Like the people that got in 20 and 21, like, oh, this is so easy. I'm just going to go do this. And look, I put a sign in the yard and I got 5 offers.
If you're not willing to pivot from that, I mean, there's a lot of people that I think got in 2020, 2021 that got in for the right reasons and care about good service.
And by the way, people that are getting in now, both, and I've had this conversation with folks, both on the real estate and the mortgage side, there's a lot of opportunity for them. Number one, they're not coming in with how great it used to be.
Right.
When you go back to 2007, 2008, my business grew. And some of that was, I brought on my very smart at the time girlfriend, now wife, who helped us market and all of that. But like I knew there was things going on. I didn't have any money in the stock market. I didn't really have a 401k.
Yeah.
Most of my money was just sitting in a checking account. Like I grew and it didn't bother me. And I was not really paying attention to what was going on in the world, other than there was a lot of bank failures. And, the company I was at the time, knowing that wasn't going to fail and that we were okay. But through that whole period,
if I think about the different experience that you and I had, because you did grow 2007 to 2009 and then kept growing, I didn't grow 08, 09, really even 2010. And it's because I wasn't all in. I was trying to do something else. I was looking at my exit. I was kind of quiet quitting at the time. I was spending a lot of time studying for the LSAT, stuff like that. And, you had your head down the whole time working.
I've been doing this since 01, but I've been fully in it since day one. And this is what I did.
That's it. And I made that decision even after I didn't go to law school. I didn't make the decision that this is what I do until probably 2012.
Yeah.
And that's when I said, okay, this is what I do. I'm a real estate agent. I'm going to be the best real estate agent I can. I'm going to figure out how to optimize this, and I'm going to work my butt off.
Yeah.
And that's whenever things started going in the right, truly in the right direction.
Yeah,
it wasn't just treading water anymore.
My point is, to a certain degree, we can all get so caught up in how bad everything around us is that we can't control,
right?
That it can really impact your psyche and take away your focus from what you should be doing, right? And now we just all have to work 6 times as hard for 25% of the pay.
I read the Gucci Mane Guide to Greatness, and there's a great line in there.
Quality.
Super quality. There's a line in there that he says, "No one cares, work harder."
That's right.
Yeah.
I mean, that's
great
exactly
line. Yeah. I do think. I mean, and again, this is kind of a broken record on what we've talked about before, but there is, the silver lining is there is a lot of opportunity. So even though, your wallet might not be getting fatter, going in the right direction right now, you're building the fundamentals to help yourself have better years in the future. And if you look at this as a long game, which again, I wasn't doing in 2008 and 2009, and my mindset was certainly in a bad place because all I was thinking about was how bad everything sucked right then.
Right.
If you look at it and say, okay, what I'm doing today is building a foundation for where I'm going to be in 3 years, 5 years, 10 years. And what is this going to do for me then? That's how you can keep your mindset really strong. So I certainly, we're struggling as well, just the same way you are. I mean, you're not going to go out of business. I'm not going to go out of business, but we're both working our butts off and not making any more money. So you kind of have to look at
work harder. No one cares.
No, work harder. No one cares. And then also think about, where will you be? What can I do in 3 years time?
Right.
So I mean, Allie and I have goals to, in 2026, we want to spend like the summer in Europe, and hopefully we can do that.
That's awesome.
Yeah. That's also 3 years from now.
Yeah.
So I think having those long-term goals and really kind of like writing them down is important, and understanding why you're doing things.
Yeah.
So.
No, I agree. I don't have a 3-year goal right now.
Keep the lights on.
Right now, I'm focusing every day on giving this everything that I've got to keep everyone here moving forward. And that's, I'm on let's get through this goal, and then we'll refocus.
Cool. So like new content, because Max and I have said this quite a bit to pretty much, I know I've said it to anyone who will listen, work harder, focus on the long term. That's how you get ahead. One thing that we haven't discussed a ton, because it's just a concept that we both really built our businesses around, are leading indicators versus lagging indicators. And I thought we could talk for a minute about leading and lagging indicators in the market, and start with lagging because they're the easiest to understand, and then move on to what's really important for everybody. And that is, what are the leading indicators of your business, and what are the lagging indicators of your business? So lagging indicators of the market, how would you describe that?
Well, honestly, I'm always more looking at leading indicators. I kind of lean on you for the lag. I'm not kidding. Like, for my business, what am I looking at? Right, I'm looking at, what are rates doing?
Yeah.
What are applications doing? How is it comparing to year over year? I mean, me, I compare every day. Like, how many apps did we have this day last year?
So to start, I think, and kind of walk everybody into this, let's talk about like I think everybody listening understands the lagging indicator, and they probably don't recognize it, of sold price, right? Like average, and just talk about from a market dynamic first. Sold price gets all the news because that's what everybody understands really well.
That's what happened.
Exactly. But in order to get to a sold price, there were a million things that had to go before that. It had to go under contract. That happened 30 to 60 days before.
Yep.
The person who purchased it made the decision 3 to 6 months before. The decision that they made was impacted by things in the market that were existing then and that were impacted by things before. So the lagging indicator, is something that I think most people focus on, and they should really de-emphasize it. It is important to know that, but I think it's more important to know what's the lagging indicator today, but where do the leading indicators point that to the future, if that makes sense.
I think so. Like I said, I mean, again, for me, leading indicators are
what you care about.
They are what I care about. Inquiries, applications, that kind of thing is really what I'm focused on.
It's funny, so I think I probably spend too much time dissecting leading and lagging.
100%.
Yeah, thank you. But I mean, I care about leading. That's really all I care about. Again, the very simple idea of, like, by the time you got to a closing table, there was a minimum of 30 days of leading indicators, leading up to it. So the leading indicator of the market is everything we just kind of went over, which are the mortgage rates, jobs, things like that. And you can see what's coming. And then for business, which is what you were already jumping into because it's so important, your laggingest indicator, right? Like the latest indicator you'll ever have is the check that you put in the bank.
That's right.
And that's obviously very, very important. But whenever I describe lagging indicators to people, I always say, look, if you are making decisions, like making business decisions, looking at, the lagging indicators, it's like driving your car, looking in the rearview mirror.
You know what's interesting about that? That is what the Fed does.
Well, for sure. We've talked about that forever. They're looking at inflation data.
They're looking at what happened and driving the car that way.
Right.
I
know we've talked. I mean, they're looking at year-over-year data, not month-over-month, which they could. If they just shifted that at all, it would make a change.
That's right.
Yeah. No, I agree with you. But no, so what do you look at in terms of leading indicators for your business? What do you look at?
Well, like I said, I mean, we're looking at applications completed. We're looking at inquiries. We're looking at applications. We're looking at locks. Obviously, seasonality plays a portion into that. So we do want to compare what was the drop from Q2 to Q3 last year. What was the drop from Q1 to Q2? Well, Q2 is usually more than Q1, but how does each previous quarter look compared to the previous quarter of the next year?
Right.
So that we can compare.
You're looking at year-over-year change.
Exactly.
Right.
Those are the big things. In the mortgage, it's funny because as a branch manager, the whoever was in front of me would always be like, "We need your yearly projections, and we need them by the month." And like, I have no idea. I can tell you what's going to happen in the next 30 to 45 days.
Right.
I don't know in January what's going to happen in November. I have no idea. But now owning a company, I mean, you still have to try to have some sort of number to plan and go for, but you're always kind of shifting direction, right? Like what the next 45 to 60, maybe even 90 days, you've got a sense. But even right now, like I have no idea what the next 90 days, what it's going to look like 90 days from now. I really don't.
Why is that? Because of churn in the market?
Well, I think that there's just so much uncertainty right now, specifically with rates, and anything could happen anytime. So let's pretend for a minute that rates drops to 5 3/4 by the end of this year. It's going to explode.
Yeah.
Right. And if rates go to 8.5, it's gonna be zero. Like it'll be not really zero, but and the market is so uncertain right now. We've become so accustomed to, in a normal environment, when you look at a mortgage-backed security, and that's what we watch all day, every day, 5, 10 basis points of change, 12, like in a day was normal. And since really the last, it's 20, like now, if the market moves 25 basis points in a day, you're like, oh, okay, that's like the new normal. But to have 30, 50, 80, like this is something that we've seen not every day, not regularly, but it's not uncommon to see those. And now, but in normal days, 25, 30 basis points one way or another versus 5, 10, 12, like rates always kind of moved slowly, right, one way or another. And now they tend to, I mean, you can see rates actually move an 1/8 to 1/4 of a point in a day now, versus over a period of time. So it's because of all the uncertainty. So it makes it very difficult. And look, there is a world out there where rates could nosedive in 30 days. I mean, I don't think that will happen, but it certainly could.
I mean, you're watching a lot of Doctor Strange, infinite universes.
Well, right, the multiverse for sure. But my point is, it's just that the market is so uncertain that to project like 90 days, now I'm operating under the assumption that December, November is going to be worse than August, September.
Right.
Like that's the assumption that I'm operating. But right. It's like lately I'm really trying to kind of focus more on 30, 45 days because it's more known.
Yeah, no, I think so. And you and I, like our perspective on it from, I guess we're both managing people. And so we're looking at what would be more macro numbers than a lot of agents are.
Yeah.
And so agents and LOs, I think, can look at the number of people that they're currently working with. And that's a good leading indicator of where they're going to be in 2 months, 3 months, 6 months. And the leading indicator that I recommend that agents and LOs look at that they can control it's their own activities, right? I mean, if you track the number of calls you're making a day, the number of text message, whatever the number outreach you're making.
How many people are you outreaching to? How many responses are you getting? How many in our world? How many applications are you taking?
Right.
How many pre-qualifications?
Same thing with agents, like showings. Like how many people are you taking out and showing it? How many people want to look at houses with you? How many sellers are interested in meeting with you for a listing appointment?
Right.
Those will be the leading indicators. That like if you are going on a lot of listing appointments, you will close more houses in 6 months, right? If that's ticking up.
Right.
So that's a good thing. It's a really good thing to track. It's a good thing to track your sales because, even though we both said that like driving while looking in the rearview mirror is not a smart thing to do, you can generally assume that your past performance will indicate what your future performance will be. So you can have a very macro idea of what next year is going to look like based on that.
Right.
And then you can look at your own leading indicators to see like how will it change?
Yeah.
I will say this. I mean, how long have you've tracked things probably since I've known you. Was that kind of a linchpin of your business growth, do you think?
Oh, certainly. I always didn't I shouldn't say always, but for a very long time, I felt like if I did less than I did before, I was failing.
Right.
So now I know that I'm going to do less in December than June or July.
Yeah.
So I know that's going to happen. But did I do less this December than I did last December? How does that stack up to what I did the December before and the December before? And I would take it so far as to, okay, on this day, today's 9/15. So on 9/15 of 2022, how many loans did I have on the books to close in October of?
I mean, the good thing is you're not competitive with yourself at all. So
right. Could you imagine? But it's always, but that's the word, right? Like competitive. It's not that I'm trying to beat anybody. I'm just trying to beat myself in anything that I do. And so it's taken me a long time and a substantial amount of therapy to realize you don't have to be better than you were at one point every single time.
I literally argued with my therapist a couple of weeks ago about that. I was like, no, but you do. You don't understand.
Right. No, I'm a couple years ahead of you on that. Yeah.
Yeah. Well, I think that, for me at least, it all started whenever I started obsessively tracking. And that was, if you remember that we called the app Transactify in 2013. And that was whenever we had hard numbers to look at and we had real year over year and you could see if you're improving. There's a book I like a lot called The 4 Disciplines of Execution. And one of the disciplines is you keep a compelling scoreboard. And they say that people play differently when you're keeping score.
Yeah.
And the story or the comparison they give is playing basketball when they're not keeping score and they're just horsing around. And then as soon as you say, okay, we're going to play and keep score now, the game totally changes.
Oh yeah.
And when you do that with yourself, if you're just like me in 2006, for example, wakeboarding, 4 or 5 days a week. And I certainly wasn't keeping score other than can I put gas in the boat.
Right.
That was very different than 2012, 2013, whenever I was like, okay, let me see if I can really improve and track it and look at it. So I feel like tracking I think it's a critical piece of improvements. Another comparison is if you're trying to get back in shape, you want to see if you're planning to lose weight or gain weight, you obviously have to track that and see what you're doing.
Yeah.
So, this is fun. I feel like we did okay. We're kind of coming up to the end of the hour.
Yeah. It's I don't know, man. You and I just talk all the time anyway. So some of this is a repeat of every conversation we've never had.
Yeah.
But I'm excited. I like to hear myself talk.
I like to hear you talk too. So,
so hopefully everybody else does.
Yeah. Well, really excited about a couple of guests who already agreed to come on the show. One of my mentors, Russell Shaw, I hit him up and said, hey, would you want to do this? I'm really, very hesitantly starting a podcast like every other dude in Austin, I think. And Russell didn't hesitate and he said, yeah. And I think you and I talked about, we're going to talk about mentorship at the next podcast and why that's really important. And, we'll use that cheesy phrase, friendtorship, I think, that we came up with.
Yeah.
Yeah. So that's what we'll talk about next and talk about why mentorship is so important. on both ends, like when you're newer, finding a good mentor or mentors, and then how rewarding it can be and how you actually gain a ton whenever you start mentoring others. So I'm really looking forward to that. I hope you are too.
Yeah, me too.
Yeah.
Awesome.
Want to thank, yeah.
I was just gonna say thanks for tuning in and listening to us yabber. If you have any questions, y'all know how to reach out to us. So we're always happy to help any way we can.
Yeah.
Thanks for having this idea.
Yeah, it's fun. I mean, it's something that I get a lot out of this. So, hopefully other people do too.
Yeah, right on.
Awesome.
Cool.
Thank you guys. Hope everyone has an awesome weekend.
See you guys. Hook 'em horns.